The account that looks safest in retirement may be the one quietly raising your taxes. In 2026, a retiree can avoid the stock market, avoid risky private investments, avoid cryptocurrency entirely, and still walk into a financial trap inside a plain checking or high-yield savings account. The danger is not that the bank fails. The danger is that the interest generated by that safe account can flow into your tax return, change how much of your Social Security is taxable, reduce your room under Medicare premium brackets, and turn an advertised yield into a much smaller real return than the number on the flyer. Most people are trained to ask one question: which bank pays the highest rate? Before retirement, that question may be enough. After retirement, it is dangerously incomplete. Every dollar of interest is ordinary income, unless a special rule says otherwise, and ordinary income can interact with formulas you never see on a bank statement. It can affect Social Security taxation this year, it can affect Medicare costs in a future year, it can affect whether a Roth conversion, property sale, or required IRA distribution pushes you over a line you did not know you were approaching. That is why cash needs a retirement strategy, not just a competitive APY. Before going further, this is education only, not personal tax, legal, Medicare, or investment advice. Do not move large balances, buy a product, sell investments, or change your withdrawal plan because of one video. Use this as a checklist, then take your own numbers to a qualified CPA or fee-only fiduciary advisor who can review your full return. The point is not to scare you away from banks. Banks are useful, cash is necessary, and insured deposits can be appropriate. The point is to stop treating interest as free money when the tax code may treat it as a trigger. Imagine a 72-year-old retiree who did exactly what cautious people are told to do. She worked for decades, avoided speculation, paid her bills, and entered retirement with Social Security, a modest pension, a traditional IRA, and a large cash balance. Her Social Security benefit is $22,800 per year. Her pension is $18,000. She receives $2,400 in taxable dividends from a small inherited fund. She also has $340,000 in a traditional IRA and $215,000 in a high-yield savings account paying 4.8%. The money feels secure because it is visible, liquid, and sitting at a familiar institution. She moved that cash after receiving a promotion from the bank. The old savings account paid very little. The new account promised many times more interest. She did not buy a risky investment. She did not hand money to a stranger. She simply chose the higher rate at the same type of place she had trusted for years. On the surface, the decision looked smart. At 4.8%, $215,000 produces $10,320 of annual interest. That number feels like progress, especially after years when savers earned almost nothing. But the tax return sees something different. The bank reports the interest on Form 1099-INT. It is generally ordinary income. It is not long-term capital gain income. It is not qualified dividend income. It does not receive special treatment simply because the account is conservative. It is added to the income stack. If the retiree is in a 22% federal bracket and also owes state tax, the direct tax on that interest can be substantial, but the direct tax is only the first layer. The larger surprise is that interest can change the taxable portion of Social Security. Social Security uses a calculation often called provisional income, or combined income, to decide how much of a benefit is taxable. The simplified formula is adjusted gross income plus tax-exempt interest plus 1/2 of annual Social Security benefits. For a single filer, the key thresholds are $25,000 and $34,000. For a married couple filing jointly, the thresholds are $32,000 and $44,000. Below the lower number, benefits may not be federally taxable. Between the thresholds, part can become taxable. Above the upper threshold, the formula can eventually include up to 85% of benefits in taxable income. Crossing a threshold does not instantly tax the whole check at that percentage, but the phase-in can be expensive. Before the high-yield interest is counted, her non-Social Security income is $18,000 from the pension plus $2,400 from dividends, or $20,400. Half of her $22,800 Social Security benefit is $11,400. Add those together and provisional income is $31,800. That is above the lower single threshold, but below the $34,000 upper threshold. Under the formula, roughly $3,400 of her Social Security is included as taxable income. This is not pleasant, but it is manageable. More important, it means she has only about $2,200 of room before reaching the next line. Now add the savings interest. Her non-Social Security income becomes $18,000 of pension, $2,400 of dividends, and $10,320 of interest, for a total of $30,720. Add the same $11,400 half Social Security amount, and provisional income rises to $42,120. She is no longer just below the upper threshold. She is well above it. The taxable Social Security amount rises from roughly $3,400 to about $11,400. So the interest did not only create $10,320 of taxable interest, it also caused about $8,000 more of her Social Security to be included on the return. If her combined marginal federal and state tax rate on that affected income is around 26%, the direct tax on $10,320 of interest could be about $2,700. The tax on the extra taxable Social Security could add roughly $2,100 more. Exact results depend on deductions, filing status, state law, and the full return. So these are examples, not guarantees. But the lesson is clear. The statement may show $10,320 of interest, while the tax interaction may consume close to half of it. The advertised rate and the usable return are not the same. This is why the message is not that high-yield savings accounts are bad. A higher rate can still be better than a lower rate. The message is that retirees must measure interest after all connected effects. A worker in their 40s might simply chase the best insured savings yield. A retiree living on Social Security, pension income, IRA withdrawals, and Medicare cannot stop there. The correct question is not, how much interest did I earn? The correct question is, what did this interest do to my taxable Social Security, my Medicare headroom, and my net cash flow? The second layer is Medicare. Higher income Medicare beneficiaries can pay an income-related monthly adjustment amount, usually called IRMAA, for Part B and Part D. Medicare generally uses modified adjusted gross income from a prior tax return, often with a 2-year look-back. That means income earned in 2026 may influence premiums in a later year. The exact brackets change, so retirees should check the current official table for their filing status. But the principle is simple. Bank interest counts in the income picture and reduces the space available for other taxable events. Required minimum distributions can make this pressure worse. A traditional IRA does not remain quiet forever. Once RMDs begin, taxable withdrawals may arrive every year, whether the retiree needs the money or not. A $340,000 IRA can produce a first required distribution somewhere around $12,000 to $13,000, depending on the exact balance, age, and IRS table. Add that to pension income, dividends, bank interest, and taxable Social Security, and the income picture changes quickly. What looked like harmless savings interest before RMDs may become the recurring income that limits future flexibility. A retiree may be safely below an IRMAA bracket today and still need to plan for tomorrow. One year, there may be a Roth conversion. Another year, there may be a taxable investment sale. Another year, there may be extra IRA money needed for a roof, a car, or medical costs. The savings interest sits underneath all of those decisions. It may not be the only reason a person crosses a bracket, but it can be the extra weight that pushes the total over the line. That is why recurring interest deserves respect. There is also a separate bank reporting issue that retirees should understand calmly. Under the Bank Secrecy Act, financial institutions file a currency transaction report for cash transactions over $10,000 in a business day. This refers to physical cash. It is not the same as ordinary electronic transfers, direct deposits, checks, or normal wires. A currency transaction report is not an accusation. It is routine compliance. The real danger is structuring, which means intentionally breaking cash transactions into smaller amounts to avoid a reporting threshold. Do not do that. If a retiree legitimately needs a large cash transaction, the safest approach is transparency and documentation. Do not choose $9,500 simply because it is below $10,000. Do not split a real $18,000 need into two smaller withdrawals to avoid a report. Use the amount actually needed, keep records, and consider traceable methods such as checks, cashier's checks, or wires when appropriate. This is especially important because retirees often face large life events: selling a home, receiving an inheritance, closing a business, or helping an adult child. Legitimate money should be handled clearly. Now step back and notice the incentive mismatch. The bank wants deposits. A promotional rate attracts deposits. The bank may be honest, insured, well-managed, and still not responsible for calculating your Social Security taxation or Medicare premiums. Its advertisement can be accurate and incomplete at the same time. The bank sees an account balance and pays interest. The IRS sees a tax return. Medicare sees modified adjusted gross income. You are the only person who has to live with all three outcomes together. That is why the calculation belongs in your hands. Start with your own annual income before counting bank interest. Include pensions, part-time work, rental income, taxable dividends, IRA withdrawals, required minimum distributions, and other recurring taxable income. Then add 1/2 of your annual Social Security benefit. That gives you a provisional income baseline. Compare it with the thresholds for your filing status: $25,000 and $34,000 if single, $32,000 and $44,000 if married filing jointly. If your baseline is below the next threshold, the difference is your headroom. That is the amount of additional income that can appear before the next formula zone. Now divide that headroom by your savings rate expressed as a decimal. If you have $2,200 of room and your account pays 4.8%, divide $2,200 by 0.048. The answer is about $45,800. That is the approximate balance that would generate $2,200 of annual interest at that rate. In the example, the retiree has $215,000 in the account. If roughly $45,800 fills the remaining Social Security headroom, then about $169,000 is excess cash that deserves professional review. It is not automatically wrong. It is simply no longer invisible. If you are already above the upper Social Security threshold, do not assume the issue disappears. Additional interest may not create the same threshold surprise, but it still increases taxable income. It may push you toward a higher bracket. It may reduce Medicare IRMAA headroom. It may make future Roth conversions less attractive. It may limit your ability to harvest gains or take extra IRA money in a controlled way. Once cash creates income automatically, you lose some control over timing, and timing is one of the most valuable tools in retirement. The solution is not to drain the bank account and create stress. Every retiree needs liquid money for monthly bills, insurance deductibles, taxes, home repairs, medical costs, and peace of mind. First, separate operating cash from emergency cash, then identify money that is not needed for near-term life. That extra cash is the part to review. Some households want 6 months of expenses available. Others want 1 or 2 years because that helps them sleep at night. The right amount is personal, but every dollar beyond that amount should have a purpose. One possible purpose is supporting a Roth conversion plan. If a retiree has traditional IRA money that will later be forced out through RMDs, outside cash can sometimes be used to pay the tax on carefully sized conversions. That may reduce future required distributions and create tax-free flexibility later if the rules are met. But conversions must be modeled carefully because they increase income in the year they happen and can affect Medicare premiums. The goal is not to convert everything at once. The goal is controlled income planning over several years. Municipal bonds may also deserve discussion, especially for retirees in higher tax brackets, but they are not magic. Tax-exempt interest can still count in the Social Security provisional income formula and may matter for Medicare modified adjusted gross income. Treasury bills, certificates of deposit, and money market funds may be conservative, but their interest is generally taxable federally. Series 1 savings bonds can defer federal tax until redemption, but purchase limits and changing rates matter. A taxable brokerage account may allow more control over capital gains, but it introduces market risk if invested unwisely. Some retirees consider tax-deferred fixed annuities or multi-year guaranteed annuities for a portion of conservative money because interest can accumulate without a yearly 1099 until withdrawals begin. That timing control can be useful for the right person, but these contracts also have surrender periods, liquidity limits, insurer risk, taxation when money comes out, and details that must be understood before signing. No product solves every problem. The best answer depends on liquidity needs, health, taxes, estate goals, risk tolerance, and the rest of the balance sheet. The deeper principle is income timing. Bank interest usually gives you very little timing control. It is earned, reported, and taxed each year. Traditional IRA money is taxable when distributed and eventually forced out through RMDs. Roth money may provide tax-free qualified withdrawals. Taxable investments may create dividends and gains, but some gains can be timed. Deferred contracts may postpone income but reduce flexibility. A serious retirement plan coordinates all of these pieces instead of letting one high-yield account decide what the next tax return will look like. This week, gather the numbers, log into every checking, savings, money market, and certificate account, and find year-to-date interest earned. If you cannot find it, call the bank and ask. Pull last year's tax return, write down projected pension income, Social Security, dividends, IRA, withdrawals, RMDs, rental income, and any expected year-end transaction. Build the provisional income calculation before and after interest. Then estimate modified adjusted gross income and compare it with the current Medicare premium brackets for your filing status. When you meet a professional, ask better questions than, "Is this account safe?" Ask, "What is my after-tax return after Social Security effects?" Ask, "How much cash do I truly need liquid?" Ask, "What balance can stay in interest-bearing accounts without disrupting the rest of my plan?" Ask, "Would a Roth conversion schedule, different bond placement, tax-efficient investing, qualified charitable distributions, or deferred income timing improve my long-term result? Those questions move the conversation away from gross APY and toward real retirement cash flow. Do this before year-end if your numbers are close. Once December 31st passes, the interest for the year is mostly locked in, the forms are coming, and the chance to manage that year's income is largely gone. You may still be able to plan for the future, but you cannot rewrite the past return. A promotional rate should not control your tax outcome by accident. The person who controls the outcome is the person who knows the thresholds, measures the headroom, and acts while there is still time. This matters because the Social Security taxation thresholds are old and were not indexed for normal inflation. The first federal taxation of benefits was created decades ago, and the higher 85% inclusion rules came later, but the dollar lines remain low compared with today's retirement costs. A retiree does not have to feel wealthy to be affected. A modest pension, a small investment account, required IRA withdrawals, and high-yield savings interest can be enough. The system can make ordinary careful behavior look like high income on paper. That is the paradox of conservative retirement planning. The person trying to avoid risk may accidentally create taxable income that erodes the value of safety. The solution is not reckless investing. It is precision. Know which dollars are monthly spending dollars. Know which dollars are emergency dollars. Know which dollars are tax planning dollars. Then place each dollar where it serves the household, not where a marketing mailer happened to point. Safety should include tax awareness, Medicare awareness, liquidity awareness, and timing control. If you currently keep a large balance in checking or savings, do not panic and do not rush into a product you do not understand. Panic is not planning. Collect the facts first, find the interest, run the provisional income number, check Medicare headroom, protect the cash you truly need, then review the excess with someone who can see the entire picture. If the account still makes sense after taxes and premium effects, keep it with confidence. If it does not, redesign the plan calmly and deliberately. Before this video ends, share this idea with one retiree who has more cash at the bank than they usually spend in a year. Not to frighten them, but to give them the question they may never have been told to ask. How much interest can I receive before it changes the rest of my retirement income picture? Like the video if it helped, subscribe for more clear retirement breakdowns, and take your 5 numbers to a qualified professional before the calendar closes. The bank can tell you the rate. Your tax return reveals the consequence. Medicare may reveal another consequence later. Your job is to connect those pieces before they surprise you. The safest money in retirement is not just money that avoids market loss. It is money that supports your life, protects your flexibility, and does not quietly work against the benefits you earned. Stay informed, stay organized, and make every dollar earn its place in the plan. USA Retirement Guide.